Perfect. So good evening. My name's Corey. I'm the Director of Communications with SEIU. And again, thanks everyone so much for joining us on this Tuesday evening. We have a really exciting night tonight with our friends Jennifer and Richard from Commonwealth, who are going to do a little bit of education and question answering around TFSAs and RRSPs. So really looking forward to learning that information. And again, these financial wellness webinars come from our member assistance program, which is something we expanded this year. Last year, we launched the member assistance program. It's mostly around helping our members who were suffering through addiction issues, substance abuse issues, making sure we're getting those members the help they needed. And this year, we've expanded that to tackle things like domestic violence, education around financial wellness, which is why you're here tonight. And then we also offer some services around housing insecurity, food insecurity, and other things that we know our members go through on a daily basis. So if you do need to access any of those services, absolutely contact the Member Service Center. You can do that through their phone number, which is on our website, and I'll put the chat momentarily. And again, through our live chat, which is available on our mobile app and our website, SEIU.ca. So with that, again, thanks everyone for joining us. I'm looking forward to some great conversation and questions tonight. And with that, I'll pass it over to Jen.
Thanks, Corey. Thanks for attending tonight. We really appreciate your attendance. This is the second webinar we've done. The first one was on saving and investing for retirement. So some of you may have attended that. We're doing this session, RRSPs versus TFSAs. We're doing the session tonight and again on April the 18th. And then we have one final session regarding government benefits and preparing for retirement. There'll be a couple sessions in June and again in November. So stay tuned for more sessions. Hopefully you enjoy this one. Just to let you know, Richard and I both work for Commonwealth. We are the pension plan administrators for the SEIU My 65 plan. So we've got lots of pension experience and are delighted to share some of that with you tonight. So with that, I'm going to hand it over to Richard, and then I'll come back for the second half of the presentation.
So as Jennifer mentioned, she did a nice introduction. We are the administrators for the My 65 plan. So both myself, my team, as Jennifer mentioned, we have lots of years of experience working with pensions, with retirement. I myself had worked at the Ontario Municipal Employees Retirement System for 3 decades before coming to Commonwealth. So I retired from there and have been here for the last 4 years in helping both the members, clients, sponsors in setting up their group plans, planning for retirement, and answering any kinds of questions and going through education for retirement planning. So here's what we're going to cover today. We're going to go through is what is an RSP, what's a TFSA, what are some of the key differences. Obviously, then you can kind of get a sense of which one is most advantageous to you or best suited for you. We'll go through some examples, and then we're going to talk a little bit about a group plan versus individual plans. So first off, we're going to do a poll just to get everybody started with understanding what does the RRSP stand for. So number one, does it stand for Registered Retirement Savings Program? Number two, does it stand for Registered Retirement Savings Plan? Number three, does it stand for Real Retirement Savings Plan? And I could add a fourth, I could say Royal Richards Soccer Pool, but I don't think Corey has that in his poll. So let's do a quick poll and see where we end up. Corey, I'm looking to you. I'm new to the poll, so you can tell me as to where we end up with the results.
Yeah, we'll just wait. I see about 20 of our 51 here have answered, so we'll just give folks a few more seconds. I know it's a little bit harder sometimes to find on their phones if they're on their phones, so give you 20 more seconds to answer, and then we'll do the big reveal.
Excellent. I will share that it's probably one of everybody's biggest pain points is acronyms. When you're looking at pensions, when you're looking at the federal websites, when you're looking at your income tax forms, there are so many acronyms, and it's hard to remember them all. And thank goodness we have Google, because back in the day, we would have to try and find documentation, paper documents, to find out what these acronyms actually stood for.
All right, so I'm looking at the results. I don't know if you guys can see them, but it looks like we've got a couple different guesses. A lot of people said your second option, number 2. Some people said the first option. I see registered retirement pension plan. I see retirement savings plan. So yeah, very mixed between registered retired savings plan and retirement services plan. But most people said option number 2.
Excellent. So most of you are on the right track. It is registered retirement savings plan. So that's good. We'll have another poll where you can try your luck on the next on TFSA, and let's keep going. I'm going to talk about a little bit. Let's go. Trying to get my screen to go forward. There we go. So savings and investment barriers. So the goal of this session is to go through to reduce any barriers that will prevent you from meeting your retirement financial goals. One of the big barriers is just not understanding the difference between an RRSP and a TFSA. So while many Canadians consider themselves very knowledgeable about RRSPs and TFSAs, there actually is very few that actually appreciate the difference between an RRSP. And again, to figure out which one is best suited for you and how you can take advantage of those products, not only now, but also in future for retirement. So just when you don't understand those differences, it can be very costly when you actually start your retirement. So the Registered Retirement Savings Plan, as you know, it's RRSP. They were designed by the federal government to help you save and invest for retirement. Your investments are tax sheltered in an RRSP until they're withdrawn at retirement, so that you pay no tax on your investment earnings. Now, your contributions to an RRSP are also tax deductible. So when you're filing your income tax return, they lower your taxable income. And again, however, when you do retire, or if you withdraw from your RRSP, that's when you would actually pay income tax. When you open an RRSP, there's actually some rules that will apply. So you have to be under the age of 71 years old. You must have a social insurance number and be a Canadian resident and have taxable income. So as an individual, you can go to any financial institution and open an RRSP. However, you may be eligible to join a group plan, just like the My 65 Plus plan, and enjoy the benefits of an associated group plan. The last step in opening an account is to decide how to invest your money, whether it be in stock, bonds, GICs, mutual funds. And that's how some of the My 65 plan can also help you with and take advantage of some of the benefits of the group plan. Contribution limits. So understanding the RRSP contribution limits is important, as you don't want to over-contribute and pay a penalty. The limit for 2024 is 18% of your previous year's income, or up to a maximum of $31,560. So whichever is less. So just to give you an example, if you made $50,000 in 2023, you can contribute $9,000. That's 18% of $50,000. And that would be for 2024. If you only contribute $4,000, the balance of that example that I had is $5,000. That can be used in a future year. So it continues to accumulate and get carried over to future years. Withdrawals from an RRSP will permanently reduce your contribution room. That means in the future, you can make up for the amount that you withdraw. Many people have more than one RRSP accounts. For example, I have one at my credit union, I have another at my bank. But remember, even though you have multiple accounts, you only have one limit, and it's based on your income tax return that you filed in the previous year, based on your income. When the government sends you your notice of assessment, that's actually where you'll be able to view your RRSP limits, or you can log into the My CRA account for when you file your income tax return. You'll be able to see as to what your TFSA contributions has been, so over history, but also what your available RRSP contribution room is. Okay, so we're going to go to the next poll, which is, what does TFSA stand for? Number 1, tax-free savings account. Number 2, tax-free savings amount. Number 3, total freedom spending account. And go ahead and click 1, 2, or 3.
The answers are coming in fast and furious this time. I think people have learned how to use the poll system. So we'll just give folks 10 more seconds or so to answer that. We've already got 50% that have answered, so just give folks a few more seconds if you want to answer. And then we'll take a look to see what you think TFSA stands for. The freedom one sounded nice. I mean, I think that's why we're all here, is for a little financial freedom, right? So, all right, I'm going to end the poll, and I see Cynthia with a question. Cynthia, we will get to questions at the end, so just hold tight, and we'll ask Richard some questions at the end. Let's take a look here. So our results. Sure, see them, but if not, I will walk through. So a lot of people were saying number 1, tax-free savings account.
Very good. That's the right answer.
It looks like every single person said that. So we got some knowledgeable people on the call.
I guess there's no dreamers out there saying total freedom spending account, because that would be nice. Okay, Jennifer, did you want to?
Yeah, I'll talk a little bit about TFSAs. So we just go to the next slide. So what is this TFSA thing? It's basically a savings plan where you can hold your investments in that savings plan. And similar to an RRSP, it was designed by the federal government to help you save and invest. But it was designed to help you save for retirement. So many people use it just to save their money in it, but saving for retirement is another option for a TFSA. Similar to an RRSP, your investments are tax sheltered when you make contributions into that account. So you don't pay taxes as that amount grows. So that's really important, a benefit to having a tax-free savings account. Now, unlike an RRSP, when you make a contribution, it's not tax deductible. So it's based on your net pay. So you pay taxes on your income, and then you make a contribution to your TFSA. So it's not tax deductible, which many people favor an RRSP just for that reason. However, when you take your money out, either through a withdrawal because you need the money or because you want to retire, you pay no taxes then. So that's the real benefit of this, is there's no taxes that you pay when you take that money out. So if we go to the next slide, and now how do you open up a TFSA? Well, there's some rules similar to an RSP. So all the rules are all different. But there's a couple common things. First of all, for a tax-free savings account, there's no upper age limit. You just have to be over 18. So if most of you are probably over 18, but if your children want to set up a TFSA, as long as they're 18 and have a social insurance number and a resident of Canada, they can open up an account. Similar to an RSP, you can open an account at a financial institution, your bank, your credit union, or if you're lucky enough, you can and have a plan sponsored by your union or your employer. You may be able to belong to a group plan, such as My 65. And as Richard said, reap the benefits of being in a group plan. It's certainly beneficial to be in a group plan over having an individual account. And again, similar to an RSP, once you set up that account, you need to decide how you're going to invest your money. So for some people, that's a big deal. A lot of people just leave it in a savings account or a GIC. There are different options. Again, options are different depending if you're with a group plan versus on your own. So just some rules on opening up a TFSA. The next slide talks about contribution limits. So yes, everything has a contribution limit. What's interesting for a TFSA is the limit is the same for everyone. So it's $7,000 for everyone. That's for 2024. If you're making a contribution in 2024, everybody can contribute up to $7,000, which is different than an RRSP. Similar to an RRSP, if you have unused contribution room, you can just drag it forward. So I might contribute $6,000 this year to my TFSA. I still have $1,000 I didn't use. Next year, it just gets added to my limit. So if the limit next year is $7,000, I get that plus the $1,000 I didn't use this year. So it's great. You get to carry that forward. Now, withdrawals, you can withdraw your TFSAs, which is really important to note. It does not reduce your contribution room. So the government in the next year will say, did Jennifer really make that contribution? Well, not really, because she took her money out. So we're going to give it back to her. So that contribution room comes back to you in the following year. That's really a nice benefit to have because people use their TFSAs often for emergencies. So it's nice to know that you don't lose that contribution room. Again, you can have many accounts, but only one limit applies to all of those accounts. So if I had 5 accounts, I cannot contribute more than $7,000 in total. And it's important to note. Now, when you have that many accounts, it's hard to track that. So you got to be really careful. And you can go into the CRA website and check out your contribution room. But it's really important to be really thoughtful about all these places you're hiding your money. And last but not least, similar to an RSP, if you over contribute, there's a penalty. So I urge you to be careful in terms of what you contribute as you move forward. So that's a lot of information. And I don't see the print on the, oh, there we go. There we are. There are a lot of differences, and you're not going to remember all these differences. It's just important to think about a couple of really important ones. And I'm going to go in and I'm going to emphasize the real important differences, okay? But to have an awareness that they're not the same is really important. And we talked about that a little bit already. So for an RSP, the contribution room, your contribution room depends on how much your income is. For TFSA, everybody gets the same contribution room. So, you know, there's differences there. They are both the same in terms of you're tax sheltered when your money is sitting in those accounts. The big one, I think the big difference for many people is on the tax deductibility. When you make an RSP contribution, you get a tax deduction. So when you file your income tax, you get a little tax reduction. And sometimes people do that because they get a little bit of money back for making those contributions. You'd get no tax breaks on a TFSA. So a lot of people kind of move towards an RSP for that reason. For an RSP, once you are 71, you've got to take your money out. So most people probably are taking their money out by 71, but you have to start drawing it down. There are no age limits for a TFSA. You can take your money out if you're 80, 90 years old. It doesn't really matter. Withdrawals, again, I think the most important thing is if you withdraw money from an RSP, you get taxed on it, but you don't on a TFSA. That's a really something you have to factor in when you take your money out. In one, you get your contribution room back for a TFSA, not for an RSP. And as I said, for an RSP, you've got to take your money, start taking it out at age 71. And I think one of the most important things I'm going to emphasize, and I'm going to give you a couple examples, is at retirement, if you take your money RSP and you start drawing your RSP down, it's considered income and it reduces your guaranteed income supplement. For a tax-free savings account, when you start pulling money out of your tax-free savings account, it's not considered income and has no impact on your government benefits. And that is huge. It's a really important point to think about. So if we go to the next slide, this is sort of what is better. It depends, but I think if you earn less than about $50,000 a year, the TFSA will really help you maximize your government benefits in retirement. So that's really important to think ahead. Are my government benefits going to be impacted in the future? Okay. And if you're making around $50,000 or less a year, you want to make sure that your money is probably in a TFSA. The other couple benefits of the TFSA I've mentioned already is you can take your money out. It's pretty easy to do that. And a lot of people have emergencies. They need that money out. And when they take it out, there's no tax on that withdrawal. And again, you get your contribution room back the following year. So some real big benefits of a TFSA. A few things for you to consider. So let me give you two examples of somebody saving in an RSP. So Amy's saving in an RSP versus Fatima. She's saving in a tax-free savings account. Now they're doing exactly the same things. They've got the same salary of $45,000. It's going up every year a little bit. They're saving $5 a day for 30 years. And so they're starting at age 35. They're saving for 30 years. They're both retiring at age 65. So exactly the same. So when they come to retirement, they're both going to have a nice pot of money. And they both decide, well, you know what? I'm only going to take so much money out in the first year I'm retiring. They're not going to take it all out. They want to make sure they have money for when they get a little bit older. So they're going to draw it down slowly. And they both decide to take $7,682 out. Now, with Fatima, when she takes that out, what I said is that $7,682 is not considered income. Therefore, it will not impact her government benefits. So there's no clawback on her GIS benefits. So she's going to get in government benefits. This is 30 years out. I'm projecting out. She's going to get $47,458 in government benefits. The total for her in that first year she retires in when she's 65 will be $55,140 a year. Amy, on the other hand, is taking her money in an RSP. When she draws that money down, it's considered income. It reduces her government benefits. So you can see right there, instead of getting $47,000 in government benefits, she's going to get $43,618. So her total income for that first year she retires is $51,000. So Fatima's ahead of AME by $3,840 a year, or $320 a month. That's huge. So that's all related to a reduction in the government benefits. So that's an example of two people earning $45,000. I'll give you one other quick example. We've got Nicole with a TFSA, Juliana with an RRSP. In this case, they're making $65,000. So the whole thing is exactly the same. The total income for Nicole, because she has a TFSA, because her government benefits aren't impacted, she's going to have over $63,000 in her first year of retirement, versus Juliana, who's got reduced government benefits. She's only going to get $55,000. So that's a huge difference on an annual basis. That's $8,000 or $676 a month, just by saving in the right vehicle. Really, really important. So those are two examples. I'm just going to do a quick overview in terms of why it's important to think about where you save, as in an individual account with your bank. On the next screen, Richard, we've got that. Are you just going to open up a bank account, or go to the credit union and open up a TFSA or an RSP? Or if you have an option, should you think about a group arrangement? And that's where your employer or union sets up a group plan, and you can join that plan instead. Group plans generally have lower fees than what you're going to pay with the bank or a credit union. And it's easier to save in these programs if, in fact, your employer will take contributions and right off your paycheck. So that whole automatic deduction from your paycheck is really important. It really helps you learn how to save. And if I look at my 65 plan on the next slide, this is a really good plan. I mean, this plan was set up for frontline healthcare workers. It's designed specifically for frontline workers because it thinks about the benefits of a TFSA for people who have a modest income of $50,000. And so I will say the My 65 plan is open to employees at participating employers who are SEIU or non-SEIU. So as long as you're at a SEIU employer, you can join the plan. Sometimes it's voluntary. Sometimes some of the employers will offer payroll deductions and sponsor the arrangement themselves. So key features of the My 65, you get the benefit of a financial wellness program. You get an actual little retirement plan at the end of the day. So it tells you some of the things you need to think about in order to save for retirement. It helps you decide how to invest. So you don't have to be an investment expert. The fees are low. You have a TFSA and an RSP option, but the plan will recommend a TFSA over an RSP if your income is a bit lower. So it helps you decide what to do. And most of all, the TFSA structure really helps you preserve your government benefits, which is unlike an RSP. So some really good benefits from the My 65 plan. So with that, there's a lot of information there. We're going to open it up for some questions. So I think Corey is going to help us with that.
Yeah, sure. So we do have a question from earlier, and I'm hoping Cynthia is still here. But Cynthia asks a great question. How does the pension adjustment affect your RRSP contribution limit each year?
Yeah, that's a great question, because some people on the call may be in a registered pension plan, like the HOOP plan, or I know there are some plans that exist out there that are defined contribution plan or defined benefit plan. Those plans have what is called a pension adjustment. It looks at the value of what your benefit is for those registered plans. And that pension adjustment reduces your contribution room, okay? So you will have less room for an RSP, and it's only impacts your RSP, not your TFSA. So that's really important to note as well.
I don't see any other questions. I saw Carla come off mute, so maybe Carla, if you have a question. If you have a question, please put it in the chat or use the raise hand function on Zoom.
Sorry, Corey, I didn't have a question. I hit it by accident. I'm just really enjoying this.
While we wait for a couple more questions, I'll put this in the chat as well. But if you are here for mobile app points, you can earn a bonus 1,000 points if you enter the code TFSA RRSP. So you can put that in the code TFSA RRSP, and if you put that in your phone, you'll get 1,000 bonus points for attending. As a nice little thank you for coming out and learning something. You're being rewarded for learning, which is great. Any other questions? Cynthia's was a great one. I myself just invested in a TFSA on the weekend. I did a GIC.
How much is the initial deposit to join the My 65 Plus?
The minimum contribution is $30 a month.
So how do you enroll? Like, what should we do? And it can be like automatically deducted, or we have to.
Depends on which employer you work for, but you can also join as a voluntary member, and contributions are taken once a month from your bank account. So again, the minimum is $30 a month directly from your bank account if your employer doesn't offer the program. Which employer are you with? Yeah.
I just put the link for most folks. I mean, I know SEIU has very few automatically enrolled, so you're probably not, unless you're, I think Care Partners is one. There's a few others that has the chance for payroll deductions, but that doesn't mean that you can't join. Every SEIU member and your spouse are eligible. So I've just put the link in the chat there. It's my65plus.ca. There's a lot of great information on there. You can track all of your investments and if it grows and all of that. And you can learn a lot the plan as well as signing up. So my65plus.ca to learn more on the site.
Yeah, and if you need any help with that enrollment, Richard and I are here to help you. You can email us at support@my65plus.ca, or you can give us a call. I think the phone number is also on the My65 website. So, yeah.
Jennifer, I think we have one more question. Two questions. I'm so tempted to answer some of these because I know what the answers are. So smart. But Gloria wants this is a great question. What's best to invest in? She gives some examples: stocks, bonds. What would your answer be for that?
Well, and I'll jump into that one too. So with the My65 Plus plan, we actually provide BlackRock target date funds that will provide you direction or suggestions as to what fund you should invest in based on your anticipated retirement date. So with these target date funds, it's actually a portfolio that's mixed between bonds, stocks, and real estate and infrastructure. And depending on your age and how close you are to retirement, those portfolios are customized for you so that, for example, if you're closer to your retirement, let's say you're 60 years old, the greater portion of your portfolio is going to be in bonds, not stocks, because you don't want to be exposed to the ups and downs of the stock market. And that portfolio will rebalance every single year as you get closer to retirement. Now you can switch to any other fund. There's about 13 different BlackRock target date funds that you can choose from. And when you go through the enrollment, we'll actually give you it's a pie chart, and you can see as to how your portfolio will be split up between the bonds, the stocks, and the real estate and infrastructure. And you can even see as to how it progresses or changes as you get closer to your retirement date. So when you do enroll, we will give you a suggested target date fund based on your current age and based on your anticipated retirement date.
I have a question. So, will you help us determine how much contribution we should put in with regards to when we are ready to retire, like almost 65?
Yes. And the great thing again about the My 65 plan, and I love this because the saying goes is, if you plan to fail, if you fail to plan, you plan to fail. So when you're going through the enrollment for the My 65 Plus plan, we'll help you with getting an understanding of what is your current earnings. And from that, we'll figure out what kind of retirement income you should expect, but also set as a target. And with that, we'll include an estimate of your government benefits. So when we look at what your current savings are, what your government benefits are, and what you can save in this plan, will help you get a sense of how much you should be saving starting now until you plan to retire.
Thanks, Richard. I'll go one more question here. I know we're a little bit over time and we're already invading folks' valuable evening time. I'll answer one and I'll pass one over to you. So Cynthia asked if My 65 Plus, you could still keep it if you change jobs. The answer is yes, and that's one of the great benefits of My 65 Plus. I can say that because I'm in My 65 Plus. I used it to save for a house, and then I was able to withdraw, which if I was RRSP, I would have been taxed on the money I withdrew to buy the house. But because I was using a TFSA, I wasn't. But if you do leave your job or you go to a different job, you retire, whatever happens, you can still continuing to contribute and withdraw from My 65 Plus. Once you're in, once your spouse is in, you're in. So that's a really great benefit that it's fully portable. You can move from job to job, unlike a lot of pension plans where if you have a pension at a workplace and leave, you can't use it somewhere else. So the other question, and then we'll wrap up, is someone asked if I'm earning $91,000 a year, how much should I contribute to RRSPs? Is there a limit so I don't get charged?
So very good question. So again, going through the enrollment will give you a sense of how much you should be targeting to save, which rule of thumb is about 60% of your earned income. We'll let you know as to how much you can contribute up to the maximum. So on $91,000, it's going to be 18% of your income that you can put into your RSP. And then for your TFSA, you have an additional $7,000 of contribution room that you can contribute. So if you're setting up, depending on the type of plan, for example, if it's coming out of your bank account on a monthly basis, or if you have a sponsored employer plan through payroll deductions, we actually have some controls in our system so that you do not over contribute based on your earnings. And then if you have any accumulated contribution room from prior years, you can make lump sum contributions directly. So to use up all of your contribution room, easily accessible.
Awesome. Thank you, Richard. And thank you again to everybody joining us on this Tuesday night. I hope you found this information valuable. I've seen a lot of good feedback in the chat, and I've had people message me offline as well, saying how much they've enjoyed tonight. So big thank you to Jennifer and Richard for tonight's great presentation. Again, a couple things if you want to go learn more about My 65 Plus, you can definitely do that. The link is in the chat, www.my65plus.ca. If you want to keep an eye on all of our webinars and future sessions, you can do that too. Make sure to have the mobile app. I just put that link in the chat as well, seiuhealthcare.ca/app. And you can download that. You get push notifications right away for all these sessions. I'm sure some of you joined because you saw that last minute little notice there, which is great. And my final thing is, again, if you have that app, definitely enter the code TFSA RRSP for 1,000 bonus points for a little reward for coming. So
already did, Corey.
Ellen's on our leaderboard. Ellen, you got to catch her. I see Gloria and Ellen, some superstars. I'm pretty sure they're points. And Vivian on the call calls me she leaves me voicemails to get points. So everybody wants their points. We're super happy that everyone's participating in that. I'm super happy you're to join us tonight. With that, I will say good night and we'll see everybody soon.